We've seen markets get frothy and correct. I've been covering markets for 35 years. So, went through 99. We went through 2019 and 2022 and the 2021 top that was painful into 2022. And I'd say that signs of a top are really reckless use of borrowing at a time when cycle indicators are at a top. One thing to be mindful of in 2025 is that the ISM manufacturing hasn't stayed above 50 for 29 months. That's the longest stretch in history. So we know businesses have been ultra cautious. Despite what people say is froth, I think it really does sync up with the 7 trillion of cash that you see. People are cautious. And when people are cautious at the top, as you know, the US has left every other country in the dust. And if we look at what really is the juggernaut of the US economy, it's technology and now digital assets. The leadership of these two sort of things driving the US economy are kind of unassailable.
Today we saw SEC Chair Paul Atkins announce Project Crypto, which will launch President Trump's vision of the US being the crypto capital of the world. Financial analyst and Bitcoin bull Tom Lee says investors should prepare for bull market highs unlike anything we've seen in 2025, and why this will matter for Bitcoin. Lee shares his take on recent economic uncertainty, with tariff and recession fears driving market volatility. Lee suggests that a major market rally is on the horizon, and that's where Bitcoin comes in. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. Bitcoin's price currently sits just over $115,000, still up over 7% in the past month. He says the next phase of the crypto cycle is critical. The bottom line, Bitcoin's next big move depends on how this plays out. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
Markets made new highs this week. I don't find a lot of people cheering and happy. Most of our institutional clients are skeptical of this recovery because they feel that there's still looming uncertainties, whether it's the FOMC or the tariff deadline. So, as you know, markets don't peak when investors are skeptical. They peak when there's over exuberant enthusiasm. There's no signs of that. They're not wrong, but I think it's the amplitude that people got wrong. So in April, people thought if you didn't have a trade deal, we'd have economic Armageddon. But now what they're finding that is if you're wrong, it's just we don't have to fall off a cliff. And so there can be diplomatic solutions or even pushing off deadlines.
Okay. They're not wrong with wondering about the uncertainty relative to those issues, are they?
You know what? There's $7 trillion of cash on the sidelines, and retail investor sentiment, I think you have to really fracture it. I think the Robinhood community is bullish, but what I'd call the high net worth and the traditional equity investor is still pretty cautious. That's the heart of our universe of clients. So I'd say that speculative activity, it's kind of, those are such small examples that I would say it's way too early for me to say they're speculation. Because
such small examples. I mean, the high beta ETF has been hitting record highs almost every day. But we're not talking about garbage stocks.
Sure, but high
either.
beta as an ETF, if you look at that, it usually should lead in a bull market. So it's not unusual, just like momentum MTUM should lead. But the thing to keep in mind is that in 2021, when Goldman cites that data, people were speculative excess in these big Mag 7 and these large cap names. There is hardly any euphoria in those stocks. But if I were to define speculative excess as someone making an assertion that is not based on current fundamentals, but then believing that their view is correct, right? That's a speculative bubble. There's a speculative bubble that inflation is coming back, and there's a speculative bubble that we are on the precipice of a recession, because that is probably the most common conversation I have with clients. And every Zoom I've done with an institutional account, always 5 minutes in, someone's like, Tom, how come you're ignoring all the risks out there? Don't you realize we could already be in a recession? So I think there is speculative excess in the fact that we're in a recession.
And negativity.
Yes, just like there was a bubble of pessimism after GFC. Remember, from 2009 all the way through 2019, it was a bubble that another financial crisis was coming. It was
well,
a
we
bubble
had PTSD,
of pessimism.
Tom. I mean, that was just not a regular occurrence.
Correct. That's right. And the market today has PTSD of trade and the Fed. The Fed is on hold, but the Fed will resume cutting once they're confident inflation is not a problem with the tariffs. Now, I don't know the date that starts, but if the Fed becomes dovish, that's more central bank liquidity. That should benefit the financials. It benefits small caps, which are highly correlated to that trade, the regional banks, but it also benefits the cryptocurrency complex because that is highly sensitive to central bank liquidity. So I think the banks and the financials and small caps and the cryptos kind of move when the Fed becomes dovish. The financials have recovered, but they still haven't become expensive. And that's because there's another lever that gets pulled. When you cut rates, then mortgages become affordable, and it actually expands the credit cycle. And keep in mind, the ISM has been below 50 for 29 months. That's the longest stretch in the ISM's history. So I think we actually, to Chris's point, if the Fed starts cutting, I actually think we have a cyclical recovery that is good for cyclical stocks. We have 15 million household formations in the past 10 years and only 13 million homes built. So we have a shortage of housing that's worsened because interest rates are high, that is actually causing home prices to stay elevated. So I think there's a policy problem. And the other thing to ask is, if inflation's at 1.8 and core PCE is at 2 and the Fed's at 4.5, it's very difficult for the Fed to explain why they are keeping real interest rates high, which really hurts consumers. So I think there's other policy measures that can be done to slow the economy, including the fact that there's all these tariffs in terms of taxes for businesses. So if someone told me there's $400 billion taxes going on to the economy and said the Fed has to stay tight, it's counterintuitive to me.
The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Lee asserts this journey is just the beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Lee highlights this being a significant development in the financial ecosystem. Embracing an unyielding enthusiasm for the Bitcoin realm, Tom Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits. By the end of 2025, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all.
I think many people, when April happened and we had Tariff Armageddon and the market went into a free fall, investors liquidated because they thought we were entering a recession. But, and as you guys had covered, like the market then staged a V-shaped recovery, which caught many people off guard because they wanted to have a chance to get in. They wanted the stock market to be like a K-shaped or flat line. Instead, it was a V-shaped bounce. And so most investors are underexposed at the moment, and they're trying to look at headlines with a half-empty view. But as you guys know, earnings have actually been really resilient, and I think it tells a very good story. Yeah. What we're saying is, instead of someone saying, oh, the MAG is making the market expensive, let's just take the average PE of the S&P of every stock, and it was around 17.6 times in 2019. Now we've had 6 what I call extinction-like events, COVID, the bullwhip supply chain effect, inflation surge, Fed fastest hikes, Trump tariffs, and then, of course, U.S. bombing Iran.
6 of them, yeah, okay.
Yeah, all of them should have wiped out earnings, but the S&P earnings have grown, and yet the equal weight PE is now 16 times. So the market's gotten cheaper in the last 6 years, despite proving they can grow earnings through 6 extinction-level events. I mean, to me, the Mag 7 have become household names. Apple is Apple, and Google is Google, and we know the product and we know the stock. And I think they have really established themselves as consumer and business companies. And for me, Apple has been sort of quietly ready to pounce on AI, but I don't think they need to pay up for any of these models. So I think Apple is going to surprise people. I think the 200 to 250,000 for Bitcoin still makes sense because that would still only value it at 25% of the size of the gold market.
Okay.
So I think digital gold means Bitcoin should be worth over $1 million per Bitcoin, and it could happen in the next few years. But maybe pricing 25% of that, especially with Genius Act, makes sense.
I don't know. Start making comments and recommendations about stablecoins?
Yes. I mean, in a sense, stablecoins are the ChatGPT moment for crypto because businesses like it and consumers are adopting it. And now we see JP Morgan and Citi and getting into the stablecoin market, and the Genius Act, of course.
How would you play that?
Well, Circle is one way because it is, a standout company. They've done really well. But Ethereum is really the way to play stablecoins because the majority of stablecoins are created on Ethereum. It's over 30% of its network fees. And if Scott Bessent's right in it, he says now it's close to a $4 trillion market. That's exponential growth for Ethereum.
Tom Lee challenges the conventional economic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures. The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Lee asserts this journey is just the beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Lee highlights this being a significant development in the financial ecosystem, selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Lee also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Tom Lee? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing?